Woo! What is up, gang? We are back at the channel. It's Mortgage Bro Science. Today we're going to talk about the difference between a lender, a broker, and a bank. And check it out. I got a little clip thing so I don't have to walk into the shot anymore. All right. So, why is this important? It's really not a mortgage is a commodity. You throw a rock, you find someone that does it, right? I just prefer banks because, they're more ethical in that sense. And I'll tell you why. All right. So, you're going to have a lender. All right. And you're going to have a broker. And then you're going to have a banker. All right. Now, the world of lending has gotten strange really ever since COVID because when you artificially lower the treasury yields and then the mortgage rates at 2.5%, all right, like people that have mortgages, right? In my last video, I said 50% of homeowners don't have a mortgage, 40% have a mortgage under 4%, and the rest of the 10% is like, oh, I got to buy a house at 7%. Anyway, so when you do this, it lessens the demand for movement, all right, and therefore, when the government really backs everything, and then you have these private banks and investors that are holding onto these bonds that they're underwater on because now the rates are higher. It creates the environment and the inflation that we are currently witnessing. All right, so technically speaking, low rates, yeah, they're good for the consumer, but they're actually really bad for banks, right? Now picture this: the bank, it's good to hold on to a loan, right? Because what's a bank? You give the money to them, they lend your money out, and they keep it in what's called the portfolio. Okay, so when they do this, now they have that bond, that 30-year fixed bond at 2.5%. All right, that's great. Yeah, it means that iron. You have a rate 2.5%. All right, now what? Now they're going to give out a CD, right? Certificate of deposit for 6 to 18 months, 2 years, what have you, for 5.3% or such. You don't have to be rocket science to realize you're underwater here. All right, but anyway, I digress. So what happens is you have a banker, a broker, and a lender. Now, lenders are what they're going to do called, they might say they're a private bank, but if they're not a depository institution, then no, they are not a bank. They are a lender. What they'll do is they'll do what's called warehouse lending. All right, well, maybe they have some form of line of credit or they're backed by, no, I don't want to say private equity, someone with dough, and they're going to let them borrow money and they're going to either sell it directly to an investor or package some loans together and then sell them off. All right, so this is what a lender does. Now, they're going to have various investors, right? And what happens is when you're a mortgage company and you have all these investors, all right, that investor that you're going to sell a loan to, all right, they're actually going to dictate your rates based on how much activity you give them. So really, they might not have that many investors because if you have 150 investors and you're only sending loans to, say, 6 investors, those other investors are still going to, A, charge you, and B, your rates aren't going to be good anyway because you're not giving them any deals. So it's kind of like you're losing money there. But they want to give an outlet because certain investors have certain lending criteria. And that's also why they could have higher rates because you might not have appropriate income and your debt to income is a little bit above this investor's threshold of what they want to see. But then this other investor could say, hey, I'll take on that risk for a premium. Shout out Big Short. You haven't watched it yet. Ryan Gosling's hilarious. And he actually explains this really, really well because the rate is all about assessing risk. The higher risk you are, the dicier it is, the higher your rate's going to be. All right. So the lenders, they're going to have about 150 investors. All right. Most of the time, it's funny, they're going to sell them to a bank. Believe that? So I always say, why the hell am I going to go to a lender? Let's just go right to the bank, right? Because everyone's got to make their fee, right? You got to tack it on, right? Because they're a depository institution. All right. A mortgage is a bond. All right. Whether it be for 10 years, 15 years, 20 years, 25 years, 30 years. The joke is now it's 40 years. Okay. So what you're doing is you're securing that money. You're tying up that money for a certain period of time. And we all know how interest works, right? Every month, interest compounds on your principal balance. Yeah, your principal balance gets lessened every month, via your mortgage payment, but you're compounding, just like your investments. Okay. So how they price out loans, because loans, again, are a commodity, they trade them on the secondary market, is they see the ROI, return on investment there, right? Assuming not even the full 30 years in which they would accumulate that interest, okay? But how valuable they are based on the risk and the 10 years. That's why mortgage rates are kind of dictated by the 10-year, because what do we always say? In 7 years, that's the average life of any loan, whether you refinance sell, foreclose, and default. We're going to see those start coming 26 and 28. I'll get into that later. So anyway, lenders, they'll package up loans or to sell them directly to a bank. Okay. Now, lenders, I don't hate as much as brokers, but lenders, here's what they'll do. They try to, their rates are generally going to be higher because they're selling them off. All right. And the lender itself's got to make their money. So what they do is they can tack on their fee to the rate or just charge it to you, the consumer, as a fee. All right. And then here's what happens. And then what you're going to do is you're going to be like, well, hey, John asshole, this bank's giving me a full % lower. And they're going to say, oh, I can match that. And all they're really doing is they're taking away their profit margin. Okay. So these guys are like, I don't want to, these guys are like car salesmen. Let's just say these guys are like used car salesmen and these guys are car salesmen. How about that? All right. And then banks aren't comparable to these two. So these guys make a lot more money on your deal. Okay. No, these two both make a lot of money. So we're going to say they do warehouse lending and they play let's make a deal. Let's make deal. Okay. So a lender can be a broker. Okay. But a broker cannot be a lender. It's kind of like the rectangle square conundrum. All right. Because at least the lenders have warehouse lending. All right. Brokers are actually hysterical. Brokers, kind of like a realtor, right? They don't actually do anything. They're just a middle liaison. All right, so they don't do any warehouse lending. All they do is they have this software that tells them what given investors or given companies are giving rates. So what they'll like, they don't even have to go right to the bank. They could say, all right, let's just say NewRez. NewRez is giving out 6 1/8 today. We're going to send it there, and then NewRez is going to say, all right, well we're selling it here anyway because we're still making our money. So then not only going to A to B to C, right, as a consumer, right, this is B and this is C. Now you're going from A to B to C to D. Now brokers, you just hear horror stories about brokers because, again, they got to tack on their fee. I actually have an old colleague of mine. He literally said he dealt with this person for many nights, many weeks, getting his home accepted, pre-approvals out the wazoo. When push came to shove, the guy was shopping him. And we've all been there, right? It's just, that's called customer service. That's a job that we signed up for as bankers, right? Sales is sales. It happens. Get used to it, all right? So anyway, this broker friend of mine, I can't say friend, colleague, we'll say, he said, oh, I can match that rate. And then what he did was he didn't redisclose. He just said he'll match it. And the guy believed him. And then all he did was when the pre-CD went out, because you could do this, it was like within 3 days prior to closing. You watch my video, the pre-CD went out 3 days prior to closing. He tacked on a fee. He got the rate. He wasn't lying. He matched that rate, but he didn't tell me he was going to charge, 2 points in fee, right? So these guys, not my favorite, right? Like I even like lenders, right? These are car salesmen. I'll write this up here. Car salesman, used car salesman. Funny story about this broker colleague of mine is they do what's called MSAs, or marketing share agreements, okay, or service arrangements, marketing sales arrangements, whatever. So it's when a lender or a broker, banks can't do this because we actually get audited by the government, right? It's illegal, okay, via RESPA, right? You can't have an exchange of anything with monetary value for leads, okay? That's RESPA, Real Estate Settlement and Procedures Act. Look it up. Not lying to you. Okay, anyway, so it's called an MSA. All right, it's illegal. He was given a brokerage, a real estate brokerage, $10,000 a month for 8 months for leads. He wasn't getting any leads. He was like, oh, what the hell is going on? And then he finds out that broker just bought his mom, not even himself, his mom, a new Mercedes. And he's like, I'm pretty sure I paid for that. He actually was a good sport about it, but it's just, lo and behold, these guys would do anything for deals, and he just lost $80,000 for these realtors that laugh at you because you're just paying for their kids' college tuition. So just tread lightly there. All right. So the brokers, I don't even know what to write here. They don't do warehouse lending. They just literally broker between a lender and or a bank, right? Now, I will give them this. They do have access to a lot more. They'll have even more access than lenders, right? Because lenders of warehouse lending, they're going to get charged that fee from certain investors, all right? But brokers, they're not, we'll say, tied to any certain investor. All right, so maybe they don't have succumb to a lot of those fees or more of those fees. All right, but they do have access to a lot more. Like, again, if you're not checking every box, if you're not a vanilla deal, it might behoove you to go to a broker because they can find you somebody that'll give you a loan. Now, the terms are going to be dog water, but somebody's going to be willing to give you a loan. Something that the bank, like I refer like the 550 credit scores over to my broker buddy, right? Because 550, like hell, when I first started, like my one buddy would laugh at me because 680 was terrible in my eyes. It was just crazy, right? So banks are going to be real conservative. Brokers are used car salesmen. Bankers, I'm not even going to compare them to car salesmen because they're actually like financial professionals. All right. Financial pros. All right. You'll find anybody, as long as you're willing to pass the test, can walk into any one of these two and get hired. Okay. Bankers are actually going to want to see you have experience. All right. It's more professional. There's more parts to a bank where you're going to be cross-selling a lot via commercial, treasury management, certain deposits, small business. Any which way you swing it, you're representing the bank. All right. Yes, I am biased. Two things can be true. Banks can be better. I can also be biased. I own that. All right. Banks are going to use their own money. Okay. So it's a depository institution. All right. So what does that mean? Again, you go to the bank, you give them your money. Okay. They then take your money in your checking and savings account, which I hope you don't do this, and they pay you 0.003% on that. All right. Hell of an interest rate, right? So with that money that they don't have just like $1 million back there. Okay. Now they then lend that money out back into the real world, whether commercial deposits. Okay. We'll say the CD rates that are paying. All right. Mortgages, if they're not selling their loans, banks don't always have to keep the loans on their books. All right. They can sell them off depending on their appetite because you could package up a bunch of loans, sell them off, make a quick profit. But mortgages are a performing asset. But anyway, back to it. Depository institution, you're giving money, they lend that money out. Okay. Now, where does that money go? So the Federal Reserve, okay, actually pays banks 10 basis points when you don't just keep all the money in your bank. Like you give it to the government, they can then dish it out as they see fit in cold hard cash, and also like flow the cash, to various depository institutions. Like, hey, I'm low in hundreds. They call one of those armored trucks and they deliver more money, right? So the Federal Reserve is going to pay 10 basis points when the banks, they have a lot of cash, they're going to give it to the government. Now it's still theirs, right? But then the government just became the bank's bank. Like we just go to the bank, right? It just snowballs. It all trickles down. So that's what a depository institution is. They actually have deposits and then can lend those deposits out. All right. Now we talked about compensation over here. I didn't talk about brokers, but we'll just assume they're the same. All right, comp. All right. Less comp. No matter which way you swing it, I always tell people I don't work on commission. I say it because I'm a banker. I have a salary, and which is not totally false, but our bonus structure and our pay structure is a lot less. Like let's just call it like 0.005. All right, that's 0.5%. That's how much you get paid on a loan. That's it, right? Versus some of these guys can make 2% on a loan. All right, now that's a huge difference. Albeit they're making 2%, their rates are worse, they're seeing less. Bank, you're going to get a lot more activity. If you're a young lender, just go to a bank, suck it up. Yeah, there's more regulation, but there's a reason there's regulation there. Okay. But anyway, so they're going to have less comp. Now, what does that mean when there's less comp? Guess what? Better rates. I can guarantee you call 3 banks and 3 lenders, I'm going to say only one of the lenders will be competitive with the 3 banks. And the reason I say that is some banks don't want to be in the mortgage space. Like Jamie Dimon notoriously says he's never made money in residential lending. All right. And then you have other leaders of the banking world, like leaders of the free world. Okay. They follow Jamie Dimon verbatim. Now, there is money to be made in residential lending, but when you're a size of JP Morgan Chase, you won't even notice that on a balance sheet. That's pennies versus the kind of money that JP Morgan Chase is making. Okay. A lot of banks still do residential lending. Okay. Just to service their communities. When you have branches, all right, part of the Dodd-Frank and the Community Reinvestment Act is for those branches to then service their communities. Okay, this is to prevent redlining, and truthfully, that's kind of the point of banks, right? Think about this. If I give you my deposits, and then I say, hey, I want a loan, and they're like, oh, tough shit, we don't do loans, but thanks for your deposits. Not only is it unethical, it's just kind of, why the hell would I bring deposits there? So it does help retain business, but a lot of banks don't like doing them, right? Like Wells Fargo backed out during COVID. Santander shut down their entire department. Okay. Yeah, Yeah, and a lot more banks are actually starting to outsource to other guys because it is high risk, right? There's a lot of government regulation. You can get cited for redlining just for lending to too many, white people and not black people. And it's just the nature of the beast. Like they're just asking us for loans. I don't know what to tell you. Like we're not out there saying no, no, no. It's just they don't call. We can't force them to call. I digress. Anyway, the banks are going to have better rates, assuming they still have an appetite for residential. Okay. True story about Chase. If you want a really low rate, you can just find someone really with a really low rate and say you're in bed with Chase, and then say, hey, get an email from that person like this is our rate, and then you go to Chase and they'll match any rate and even give you an eighth lower because they don't actually want to be competitive. They just say if you find something better, we'll just match it. Like, that's how little J.P. Morgan Chase cares about residential lending. They're just out of the market always. But if you're a customer and you say, hey, this guy's offering me this, you send them an email with that exact terms, not even a loan estimate, they'll match that. Anyway, so banks are going to be better. All right. Yes, there's more regulation. Okay. Yes, they still have to abide by Fannie and Freddie, but these guys, they'll more than likely have more outlets. Okay. Like larger banks, we're not going to do bank statement loans. All right. Larger banks are not going to do DSCR loans. Okay. We're not going to do ninja loans. We're not going to do anything that's really, really sketchy. Okay. Like FHA loans, some people do 550. Still only get on to 650 because we just don't want, not even that unconscious. We just don't want that. That's not our appetite for loans, right? Loans are risky as it is. So why banks make money other ways, whereas brokers and lenders, they only make money one way. That's selling loans. So of course they're going to try to sell as many different which way loans as we can. Also true. Look this up. Rocket Mortgage. Everyone knows Rocket Mortgage. They sponsor the Houston Rockets. They're United Wholesale Mortgage is a broker. Rocket Mortgage is a lender. Vice versa. All right. United Wholesale Mortgage, Rocket Mortgage in particular, they have a denial rate of like 70% because everything's online, which is great. And then if no one's actually explained anything to you, you have dumb fucks in like Ohio and Iowa that just answer the phone. You don't know who the hell you're talking to. And if it's not like strict W-2, they didn't actually train these people. They just get denied and then no one calls you and you're dead out of water, right? So definitely tread lightly when you just find someone online. Again, that's why any community you live in, you're going to have a local bank. All right. If your local bank doesn't have a saleable outlet and they have portfolio loans, then they're going to be a little more flexible, right? Because it's not saleable, so it's not subject to Fannie and Freddie strictly. If they're keeping it on the portfolio, they'll have a lot of wiggle room when it comes to underwriting, like the common sense rules, right? And at my previous smaller bank, there's some loans that no way in hell my current bank would have done, but not only were they a customer, but it made sense. We weren't selling it. All right. So it does work. So this is, again, why I always say, call your local bank. They have better programs. They have better rates. They have more professionals. All right. You can always run into the branch and raise hell. A lot of these guys, there's not even branches for some lenders and stuff. They just represent a name. So they quite literally can just block your phone and you can never talk to them again. All right. I can't hide. Someone always knows where I am, which is good. So, not to mention, you go to a bank, remember I said auto debit and bring over deposits, you're going to get a lot lower rate. You could build that relationship, especially if you want to be self-employed at one point, right? Like all the commercial guys, small business guys, when they have a relationship with a bank, you treat them right, they treat you right. It's symbiotic, right? Spider-Man, Venom. So that's the difference. Brokers, they're to use car salesmen. They don't actually do anything. They just find a low rate and place you somewhere, or a high rate, and then they can charge fees on top of that lender or bank's fees. That's the best part. They'll charge additional fees that you don't have to pay. So why the hell would you call a broker? Because your realtor is getting paid by them. That's why you got sent to a broker. Take that to the bank. That's 100% true. All right. Lenders, I could tolerate, but they can still play let's make a deal. If they're charging 2% and they're like a point over, right, on any other rate, they're like, oh, actually, I can match that. And they'll just cut their comp. That's all it is. They'll just cut their comp. And it's really unethical. It's illegal. Fair lending issue because you need to offer that to everybody, but I digress. Lenders and brokers, they're not audited by the OCC or the SEC or the CFPB. All right. So it doesn't matter what they do because they're not going to get audited. Banks get audited. Right. So, yeah, a little more tolerable. Still sleazy. That's why it's a sleazy business. But go to a bank. This is the difference between a lender, broker, and banker. And I really hope this is helpful. If you ask why am I shirtless, why aren't you shirtless? It's summer out. But yeah, that's Mortgage Bros Science. Please like and subscribe. Send us to anybody. And my last comment is I post shorts and I actually get pretty good traction. But then I post something like this. I know it's long and you got to hear me talk, but it's good information, right? I'm trying to teach you things and I don't get a lot of views. So just what's up with that? Anyway, like and subscribe. And yeah, talk to you soon.